Okay, hi guys. So this is part 7. We're moving on to borrowing costs. And really the theme here with borrowing costs is that um, you are allowed, if you're borrowing money, to carry out the construction of a non-current asset. Remember, a non-current asset is an asset that we use within the organization to generate income, um, to capitalize the interest, if you like, because technically it is a relevant cost. That cost is connected, if you like, the cost of finance is connected to the, if you like, to the acquisition and to the construction, really, of this organization. It seems only fair. But of course, the argument really is that we must strictly, if it is strictly for that purpose, use it for that purpose, and only for the period of that purpose. So no one argues that the argument isn't really about whether or not we put through a debit. The argument is just about whether or not we capitalize. So we're really talking about debit asset versus debit expense. In some scenarios, you might just have to debit expense because you are not using that finance for the purpose of construction at that time. You might be using the finance for whatever else in the organization. And so put through the finance that through as an expense, as a finance expense. But in terms of capitalization, it must be to do with the construction, if you like, of the said asset. Right. So this is what I'm saying here. Borrowing costs must be capitalized. When I was studying, you had the choice of expensing the whole thing or capitalizing. And I think there was maybe a lack of, I can imagine a lack of consistency, confusion, and the inability to compare one organization with the next. Because if one organization says our policy is to, because this is really policy, isn't it? Our policy is to capitalize, versus another company that says our policy is to expense. We cannot, if you like, objectively compare profits and if you like, make decisions, make good economic decisions based on those comparisons. So borrowing costs must be capitalized as part of the cost of an asset if that asset is a qualifying asset. Again, when we talk about a qualifying asset here, an asset that's taking a substantial period of time to get ready for its intended use or sale. So, of course, again, this is my point. My point is that if you take out finance in January, but you only start construction in March, well, you can only capitalize the costs that are related to the construction of this asset from March. You cannot capitalize January and February. That was not, if you like, it's an interest expense, but it is not a capital cost. So typically capitalization of borrowing costs should commence when all the following conditions are met. First one is that the expenditure for the asset is being incurred, and the borrowing costs are being incurred, and the activities that are necessary to prepare the asset for its intended, so as you say, intended use or sale are in progress. So we're actually using this thing to actually build. Now, the other issue here is that it is possible that someone takes out some money to finance an asset, but at the same time takes some of that funding and invests it and is actually making income. Now, the standard cannot allow you, as you can imagine, to sort of take out a loan. I mean, there's nothing wrong. I mean, here's what I'm saying. Say, for example, you take out a loan on your own, as you wish. Take out a loan. You incur the expense, but you also lend the money. So you incur an expense at 2%, and you lend the money, and you make money at 4%. Well, that's perfectly normal. People do this every day. So ultimately, this will be interest income, and this will be interest expense. They match, right? The matching concept. Thank you so much. But if you could cleverly take this 2% and then go along, and instead of expensing it, you go along and you capitalize it so that you don't actually have an expense, and you're only recognizing income, then, if you like, technically that would be fraud, because we don't have a matching expense here, and you're making income without actually incurring an expense. So the standard does not allow you to recognize income on finance costs, if you like, or loan that you've taken out for the purpose of construction when you're capitalizing it. So when you're capitalizing it, you have to also net off this income against that capitalization, and if you like to reduce that, the benefit of capitalization, if you like, in line with the matching concept. So no one in effect is saying you can't borrow to lend money. We're just saying you cannot enjoy the benefits of capitalization of your expenses and yet enjoy as income, if you like, any money made on the lending of those funds. Which is why it says here that borrowing costs which may be capitalized are those that actually incurred, less any investment income on the temporary investment of those borrowings. Right, so here we have an example. I think what I should also do is let me quickly create a blank. Let me create a blank page. Cool. Right. So we have, it says here, Wilson receives an 18 million 5% loan. And I'm going to do a double entry so you actually see what's going on. I think that's helpful. Receives an 18 million 5% loan on the 1st of January to finance the construction of a new factory. So let's do the double entry. So what happened here was he got, I'm going to put here bank, and I'm going to put here, here's the loan. So he received 18 million in the bank, if you like, and that's the first transaction, right, on the 1st of January. And it's a 5% loan. So technically, let's calculate it. So at 5%, he should, let me get my calculator, 0.05 times 18. So 0.05 times 18, so he should be paying 0.9 million. I believe this is all in million. Yeah, this is in million. So you should be paying 900,000 or 0.9 million every year. I'm just going to make it so this is per annum. Right? Per annum. I'm going to just say what it should be monthly. Right? So 0.9 divided by 12 is 0.075. So monthly, the interest is 0.075 million, right? I mean, that's what this is. This is 75,000, but this is 900,000. I don't know. I prefer sticking with the decimals, but you know what I'm talking about. 750,000 or 900,000, and this is 18 million here, 18 million here. So every month we will accrue interest of 0.075. Right, and that's kind of, so you can really see in practical terms, if you were in practice and doing the journals for this, you'd know what was going on. So it says, first of all, as the funds were not all required immediately, Wilson invested 6 million in 2% bonds on the 31st of May. I'll come back to this. But the key point I want to start, the first thing I want to talk about is construction of the factory began on the 1st of March. This is important. So here is my finance cost. Right? So the first question here is this, that construction begins on the 1st of March. So I start accruing interest. I mean, interest starts to happen in January. But because there's an interest cost, I need to debit something. Let's just say I was paying the interest straight away. Let's just say I was paying it out of the bank. I don't know. I'm just saying paying my interest, which is probably the case, paying it, if you like, monthly. I will pay January and February, of course, 0.075, 0.075. But I cannot capitalize this finance cost yet because it's a cost, but I just have to recognize that cost as a normal finance cost, right? Like a normal finance cost expense, because I'm not using it to make the factory just yet, if you like. So either I'm paying the interest or it's accruing. It doesn't really matter. This is not really the point, really. When I say bank, I really could put this 0.075 in here, but I'm just putting it here separately. Right, but this is my interest. So what I can start doing from the 1st of March is, I'll just change my pen color, is that I can now put, if you like, finance costs to be capitalized. What I can capitalize from here, I can now put the 0.075 here, if you like, when I get my asset. So I guess I could call this asset, if you like. I could create another account called asset, and in that I can start putting from March 0.075, April 0.075, right? And I'll just quickly get rid of this bit one here. So you can see I'm starting to capitalize my finance costs from March, April, May, 0.075. And then let's see how far it goes. It says that we went all the way to the 31st of December. So I will have basically 0.75 10 times, right? So let's just do that. Just do that again. So that's 0.075 times 10, which is 0.75. So I can capitalize 0.75. That's the first thing, right? For 10 months. Right. Now, let's change my pen color just to go back. Now I can go back and talk about the... and that's the main thing. This would have all been wonderful, and that we would have ended things there. But our friend Wilson also invests 6 million of that money in a 2% bond. So my point is, he could have taken out a loan for 18 million and invested it in different areas, like I said. So what am I saying? So he could have, there's nothing wrong. You can borrow money and do that. So he goes along and he takes out, he invests 6 million, if you like, into some, if you like, credit, and he basically, and he buys some bonds. I'm just going to put here bonds worth 6 million. And these bonds are accruing interest at 2%, if you like, per annum. So let's take 2%. 2% of, right, 0.2. So these are bonds, right? He buys bonds, financial asset, right? Pieces of paper where he has the right to income. So 6 million left the bank. He's got these bonds of 6 million, and he's making interest 2% on that 6 million, and that's I'll just do that calculation here. So 6 million times 0.02 per annum is 0.12. Well, over 12 months, he will be getting 0.01 each month, right? Now, what am I saying? For the first month, January and February, well, nothing is happening. He's just got money in, there's got a cost, and is also making 0.01 for the first two. So for finance income, so he's making income, if you like. So we have finance income. So he is receiving 0.01 in the bank, and he can recognize that finance income 0.01 as income in his income statement. And then the next month, so January and February, he can recognize the first two 0.01. Very good. Now, from then onwards, when construction begins, you see, technically, if we could recognize, you could say, but can't I just keep recognizing March, April, May for the 5 months, if you like, in finance income? Well, no, we can't, because he's not recognizing those corresponding costs under finance cost expense. What will happen here is we will now have some sort of asymmetry where we are seeing income being greater than expense, and that's because he's capitalized those costs. So in a way, and that is technically fraud. You cannot be recognizing income that does not match the expense it's related to. If you like, your accounts will look much better than other people, because right now he will look as though he has a lot of income compared to the expense. So what he has to do, if you like as well, is to recognize that income, or if you like, net off that income against the expense, if you like, that. So here we are, 0.01. That was January, that was February. So the money comes into the bank, 0.01. That's for March. But we recognize it within, if you like, against the expense that was capitalized, to basically reduce that, if you like. So we have March, April, May. Yes? And that's the theory, if you like, of how we deal with this. You just have to be very careful and cautious. But really, all we're doing, you see, is following the accruals concept. And we're matching income with expense correctly, if you like. You can see here that we're only, whatever we capitalize, the expense, the finance cost that we capitalize, we're also matching the finance costs that we accrue income on. And it's also, again, like I say, it's unfair. It's not a faithful representation of what's taking place. It's a bit like how once upon a time people were able to, it's a bit like that, where people were able to recognize, um, if you take out a buy-to-let, for example, you could recognize the interest as a on the loan, sorry, the interest on the mortgage as an expense, and recognize the income, or you could capitalize the interest or whatever it is, and then recognize the income separately. It's the matching isn't taking place. We need matching to be fair. So you can see this is what happens. So for the 2 months here, for the 2 months where nothing happened, we can see we recognize finance costs on their own as normal expenses, and we recognize finance income on their own. That's fine. But as soon as construction begins, we can now capitalize this, which in a way is deferring that cost to the future, so to speak, and therefore you cannot suddenly enjoy the benefits of that income. We must also recognize that income against that. So technically, your net figure here becomes 0.72, right? Because that's what your, if you like, 0.75 minus 0.02 is 0.72. So your net realization, or the figure you're really capitalizing overall, is, if you like, 0.72, right? And that's how you deal with that. Okay, great stuff. So yes, I think that's, I'll stop there. I've already done 16 minutes, but I had to because it's a bit of a long bit where you need to understand what's going on. So we're just going back to the question, just so that you're happy with what we're doing, so you can see where we're coming from. Calculate the amount of interest to be capitalized. Yeah, that's it, 0.72. 0.72. Cool, great stuff. See you in the next video.